Hello again, traders. Dwayne here from DRFX, Forex and Trading. Going to be taking a look at the recent trade that was made on the Euro Pound, which provided us with a strong trading gain of 50 pips over the last couple of days. This trade took place on the 4-hour chart of this currency pair, where the market had created a set of waves that suggested that the market was going to be forming a consolidation setup. This was looking as if it was going to take the form of a pennant, with a resistance boundary already formed here with these two resistance points, and the support boundary needed to be completed with the formation of a second support point that would be completed by this projected bullish movement, which will complete the formation of the support boundary and hence the overall pennant consolidation. Now, the reason why we were expecting the market to form that consolidation was based on the fact that when the market presents certain types of bullish and bearish waves, it usually suggests that the market is going to be forming a consolidation setup of one form or the other. Now, as you can see from this snapshot of the trading manual that I use, here we see that the market, you see examples of the types of waves that generally indicate that the market is going to be forming a consolidation setup. So these are the types of aggressive movements, bullish followed by bearish waves, that usually lead to the formation of resistance and support boundaries and thus consolidation setups. So this was the idea behind what we were expecting to take place on the 4-hour chart of the Euro Pound. So under the assumption that we were going to see the market rally, we essentially sought to take advantage of this strong bullish U-turn by entering at the close of this candle and placing a stop loss just below the formation of this signal. The target was set to an area just below the resistance boundary, which essentially translated into a stop loss of 30 pips and a trading target of 50 pips. Now you may be wondering, why is it that we are aiming for 50 pips when the trading strategy is to aim for 70 pips? As you can see here in the section where I describe the trading strategy, the main aim of the strategy is to capture 70 pips using stop losses of 40 pips. Now what this means in terms of percentage returns is that, assuming that you're using an average risk per trade of 2%, a risk of 40 pips and 70 pips would translate into a trading return of 4%. However, if we have a situation in which the market, we're trading a currency pair that has a slightly smaller range of movement, if what we're seeing on that currency pair is a situation in which we can use a smaller risk and target a smaller range of movement, which would still provide us with a return that is close enough to our benchmark return. In this case, this would be 3%. Then we can work with it. So it is something that we can use. So it's a rate of return on this trade that is strong enough. And if you're risking a 4% per trade, it will also be within the ballpark of the average of 8% per trade. So this was deemed strong enough. The return was deemed large enough to justify the trade. Now here, as you can see in the live view of what has taken place on this currency pair, the market did rally and did provide us with a trading gain, as it rallied and hit our limit order and provided us with a trading gain of 50 pips. Now one of the things that you'll notice is that this was the candle that started the movement, and after 1, 2, 3, 4, 5, 6 candles, the market had not yet hit the target. Now, as you know from the trading strategy that we have, each trade is supposed to take 24 hours. So after 24 hours, regardless of the number of pips that we're up, we would close the trade, because generally speaking, the market usually requires less than 24 hours to hit these types of targets. However, so in most cases, in all cases, we would usually close the trade at this candle, which is where the market had ended up at the end of the 24-hour holy period. But because the market had closed with this strong signal to indicate that the market was going to be moving higher, what I did was to essentially move the stop loss from where we had it at this level here and moved it to break even, and essentially ensured that we would not lose on the trade, and waited patiently for a few more hours until the trade was hit, until the target was hit. So a very good trade, providing us with a strong return within just over a day, and it's another example of how we can take advantage of these types of movements and these types of signals, waves, bullish and bearish waves that lead to the formation of consolidation setups. So once we know what is taking place on the currency market using the theory of candlestick patterns, we can take advantage of it and capture strong trading gains within a very short period of time.